By the end of this video, you're gonna have the tools to know exactly how to make money day trading in the stock market. If you can master the art of trading, financial worries will be a thing of the past for you. But if you have the wrong fundamentals to begin with, you're gonna be burning your money away in the process of learning how to trade. It's gonna be very crucial for you to watch this video through to the end to understand the basics every trader should know. Before we dive into learning about the technicalities of trading, I wanna make one thing very clear. The beginning stages of trading is gonna be by far one of the hardest things you're gonna learn throughout your life. This path, this journey of becoming a successful trader is not one for someone who is going to give up within a year. I'm not gonna sugarcoat it. This process is gonna be grueling. It's gonna bring you up and it will tear you back down. It is going to hurt so bad. You're gonna question yourself, why did I even start this in the first place? And then you're gonna remember, I know I want more for myself. So with that being said, let's get into what you should expect within your first year of trading. First and foremost, there's gonna be a learning curve. You're gonna have to take time and effort to develop the necessary skills to understand the market. Second, expect losses. No trader has gone their entire career with no losses, so you're gonna have to accept it. Third, realistic profit expectations. Within your first 6 months to a year of trading, you're probably gonna lose money rather than make money. So you have to accept that fact. Fourth, do not drop everything for trading. If you have bills to pay, you got things to do, family to take care of those things first and then develop your trading. If you are not in a good spot to be trading, you should not be trading whatsoever. And fifth, you need to have a long-term perspective. If you think trading is gonna make you rich quick, you need to stop watching this video right now, because that is not gonna happen. You're actually gonna lose all your money trying to do that, and your life is just gonna go down the drain. So with those expectations now set, the tone is now set, let's dive in how to tackle the financial markets. First things first, you guys are gonna wanna understand market terminology. What does this include? It includes being able to read and understand price action. It also consists of the terminology regarding technical analysis. And as traders, we observe the markets through a lens of technical analysis when making a trading decision. Grab your notebook, grab your pen, because we're gonna get into the basics of technical analysis. If you guys have ever seen a stock chart before, you've probably seen this green box and this red box. What these are called candlesticks, and what they represent is what price is doing in that moment. Being able to read and understand these is very important, because then you're going to understand price action. To begin with, let's start with the green one. We're going to start at this bottom. What does this represent? This represents the open of this candlestick. When this candlestick formed, it opened at this price. And the top part right here is going to represent the close of the candlestick. So we started here and then price closed above, signifying an increase in price. Hence why it's green. This wick, these are called wicks right here. The top of the wick is going to be the high of the candlestick, and the bottom of the wick is going to be the low of the candlestick. So the wicks, the high represents the highest point price reached during that period, and the low represents the lowest point it reached during that period. And now to the red one, if we start here, this will be our open, and then right here will be our close. So the red ones signify a decrease in price, meaning we opened price here, and then once the candlestick closed, it closed right here, and then boom, this was the highest price, and boom, this was the lowest price for the candlestick. Now the next topic I want to cover is trends. How do we identify trends? So we see price coming down, starting to go up, going up, coming back down again. Now what we want to look for in a bullish market is price creating higher highs and higher lows. So what we have here, price going up, creating higher high, Price coming down, creating higher low. Price coming up, creating higher high. Price coming up, creating higher low. Price going up, creating higher high. Price going up, creating higher low. What does this signify? This signifies that we are in an uptrend now. So, and we can mark it with these channels, and we can see at these points the higher highs and the higher lows. Now we know that we're in a bullish market. And to the flip side of this, we have price coming up, creating a peak, coming down, lower low, lower high, lower low, lower high, lower low, lower high, lower low. See that we have the channel. Now, it's not going to be perfect, because if it was perfect, the stock market would be super easy, right? So it's going to be skewed. There's going to be false breakouts, but the general direction we now know is bearish. And the last trend I'm going to cover is consolidation, meaning the market is moving very sideways. So we have price coming here, very consolidated, creates a low though, creates this little low, moves up, creates this high, moves back down to the same point, moves up again to the same point, moves down again to the same point, moves up again to the same point, moves down again to the same point. So I bet you guys get the idea at this point that price is trading very, very sideways, and this is called consolidation. We're going to shift our focus to support and resistance. How do we find support and resistance? We see price coming down, creating this low. That would be support number one. Then price comes up, creates the resistance, resistance 1. Then we have it again, support 2, resistance 2. Support 3, resistance 3. Now, I know I just made an example of the trend that we're consolidating, but we can find support and resistance within the consolidation, or within an uptrend, or within a downtrend. So what we want to do with these support and resistance levels is these are defining our areas of entry points and exit points. I do want to make one thing clear though about support and resistance levels, is that once it comes back down to it, that third support level is going to be weaker. So we come up to that third resistance level, and then we come back to that fourth support, right? Notice how it's a little higher up, and when it goes up less. Once support and resistance has been used multiple times, that level is going to become weaker because there's less orders sitting at those levels now. So now that we've talked about price action and how to read and understand price, as well as market structure, identifying bullish and bearish and consolidating markets, now we can go to our next area of discussion, indicators. So I know there's a lot of backlash with indicators in the YouTube trading community, but indicators are a great tool to use when determining how to structure your trades. On this chart, we have what's called a moving average. That's the blue line and the red line. Now, what is a moving average? A moving average is the average price for a specific period of time. The blue line signifies a 20-day period. So for the last 20 days, the blue line is representing the average price for the last 20 days. And the red one is representing the last 200 days. So it has a lot more price averages to it rather than the blue one. And what that means is the blue one is going to be more for short-term trading, whereas the red one is more towards long-term investing and finding those long-term entries. Now, as you can see, I added another moving average. Now, this moving average is slightly different. So the blue and the red one are called a simple moving average, aka SMA. And the green one is called an exponential moving average, aka EMA. Now, the difference between the simple moving averages and the exponential moving averages is the exponential moving averages puts more weight, more emphasis on recent price action. Now, an easy way to think of exponential moving average is Think about at school when you took a test and some people did really bad, but others did, pretty decent. The exponential moving average is going to be that curve that those teachers gave you, whereas the simple moving average is just the strict numbers, no curve, no nothing. But the EMA, exponential moving average, is basically that curve that the teacher's going to give you. At this point in time, we're going to shift our focus over to volume. Now, what is volume? Volume is the number of shares or contracts traded in the market during a specific period of time. Using volume, we can find areas of interest where there's going to be dramatic increases or decreases in price. If we're looking at this chart here, we can see during this period, there's not a lot of volume being traded. But once we reach that peak, there was a huge spike in volume, right? Now, once there's another big drop off, another big spike in volume. And then, as we can see recently, when there was this huge drop, but also a big increase, there was an astronomical amount of volume during that period. Now, what this signifies is a dramatic decrease and then a dramatic increase in price with confirming tons of volume. That could be signs of reversals, trend reversals. And also we have this low going up, creating the higher low. And that could be another sign of a trend reversal. Another thing to consider when looking at volume is we see that price is increasing here, right? But if we look down at the volume, we see that volume is decreasing. Now, this is a divergence, and divergences could be indicators that price is going to change, right? Moving on to our next indicator, we have the RSI, and this can be seen on the bottom half of my screen. Now, what is the RSI? It is the Relative Strength Index. It's a momentum oscillator that measures the speed and changes of price movements. It ranges from 0 to 100, but if it's over 70, then the market conditions are considered overbought. And if it's under 30, then the market conditions are considered oversold. So how can we implement the RSI in our trading? We see market going up, up, up a lot. And notice this is a daily time frame. So this is a lot of information we're taking in. We reach about 81 on the RSI, and then price goes down, right? And it comes back up to this 81 again, but price is even higher at this point. So knowing that the price is already considered overbought and it went up again, that would be a great time to short the market. This is just one example of how you could identify a solid trading entry with the RSI. But I want you guys to remember when we talked about support and resistance, right? So if we look at the RSI, we can use support and resistance, that concept, to our advantage, right? So notice how the market, it went up, came down, and then shot up even higher. It broke through that resistance level in the actual market, but if we look at the RSI, it formed a perfect resistance level, showing that this would have been our point of entry using the RSI, right? And same with this. If we look at the oversold conditions, we have this oversold around the 30 with the RSI, and price was right here. But we go boom, 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 look at the RSI, price was higher, but it landed on the same spot. So using the concept of support and resistance with the RSI can be very beneficial to your trading. Now, the last indicator we're going to talk about is called the Bollinger Bands. Now, like I mentioned before, the Bollinger Bands actually use the simple moving average, and that would be this middle band that we see here. And I don't know if you guys have taken statistics before, but it uses the standard deviation for the upper and the lower band. The standard deviations are based upon that middle band right here. And what it tells us is basically where the outliers are. If price is above that overband, it's overbought. And if it's under that lower band, it's considered oversold because it's over 2 standard deviations away from the mean. When I finally understood that concept, that the mathematics behind the Bollinger Bands uses, real life statistics and standard deviations and finding those outliers, it really brings that confidence to your trading that is hard to find with a lot of indicators. So now that we've gone over some basic market terminology and also a lot of indicators in the market, this is going to provide you a solid foundation and understanding of what you're actually looking at in the markets. Obviously, I would do further due diligence on certain indicators that fits your personality and that you like to really build the confidence to actually use the indicators in your strategy. Because if you don't, you're not going to follow your trading plan right, your risk to reward's going to be messed up, and it's overall just going to lead to a terrible experience using indicators. I wouldn't use all the indicators at once because what that's going to do for you is cause analysis paralysis. And I don't know if you've heard that before, but analysis paralysis is when you have too much information coming in at once and you don't know what to do because you have too much information coming in. We want to keep our trading very simple because if you have too much information going on at once, we're not going to be able to execute quick enough. We're not going to be able to execute well enough. And overall, it's going to complicate and skew your trading overall. Shifting gears to the next main point of this course would be you have to trade on a demo account. Why should we start on a demo account? Well, there's a ton of valid reasons why a beginner trader should start on a demo account. With the first being, you're gonna have risk-free practice. If you go into the markets as a beginner right away, you're diving into the ocean. You're just a little fish in the ocean. And what's gonna happen to you? The whale is gonna swallow you up. Secondly, you're gonna become familiar with the broker that you're using to execute your real trades. Why would you not practice with risk-free money and learning how to operate your broker, learning how to execute trades, and all that good stuff when you're not risking money at first? Me personally, I didn't do this when I started trading, and honestly, I lost thousands of dollars just because of this simple fact. The third reason is you're going to be able to learn how the market moves. You're going to learn the structure of the market. You're going to learn all the concepts that I was teaching you before, and it's really going to start engraving in your mind, and you're going to learn, you're going to be able to see things that you have not seen before, and it's going to be amazing. It's going to be great because all of it is going to be risk-free. We're not losing money in this process. So it's just a win-win. You're also gonna learn some emotional management, right? I mean, although it's risk-free money, you're gonna look at that number, that P&L, and you're gonna be like, whoa, went down that much, went up that much. Your emotions are still gonna be a part of it, but it's obviously not gonna be as drastic. Another reason to start on a demo account is you get to journal the trades, right? Journaling your trades is very important because let's say you take a certain setup, right? You want to document that because if you see that setup again, then you'll be able to see, oh, did it work out again? Did it not? Then you could really take a tally of how many times that exact setup is going to work in the real markets. There's one very important thing that I do not want you to forget while on the demo account, and that would be risk management. Although yes, it's fake money, it doesn't matter, implementing the correct risk management, making sure your risk to reward is good on the demo account is just as important as implementing those things in the real trades, right? Think about it like this. You're playing a sport and you're at practice. You want to practice how you're going to play in the game, or else how is that practice going to transition to the real game? What does that mean? In the demo account, we want to be trading with actual money amounts that we would trade in real life. We want to simulate realistic things we would do with our real money and our real trades. Therefore, it would transition a lot better once you move over to those real trades. Overall, starting with a demo account is only going to save you money in the long run. Think about it. Most traders don't see their first profits until about 2 to 3 years of starting trading. And maybe some cases it could be 1. All things considered, we want to be able to show that we can make money with the fake money before we make money with the real money. Now, you could go on a demo account and take 1 or 2 trades and say, oh, I made a profit. But if you were to take 200 consecutive trades, are you going to be profitable at the end of it? Some of you might say no, some of you might say yes, but I'm going to 100% change the rules in your favor for that profitability to be so much higher of a success. How can I make such a guarantee? Well, imagine we have this quarter, right? Heads and tails. We flip it. Every time we land on heads, we get $2. Every time we land on tails, we lose $1. Wouldn't you want to play that game? Since there's only 2 sides to the coin, meaning there's a 50% chance that it will land on heads and a 50% chance that it will land on tails, overall, if we were to flip that coin 1,000,000 times, we would be making money in the long run. Now you're like, how is that game fair? And the answer is, it's not. We are bending the rules in our favor, and that is exactly what we can do within our trading. Rule number 1 to bend the rules in our favor is our risk to reward ratio. This would be the game we just played. Now, having a risk to reward ratio does not necessarily mean that we're going to make more profit. But what this is going to do for us is bend the rules to our favor, where we can stay in the game if we take too many losses at once or, in a row. We're going to be able to stay in the game of trading to eventually skew the risk to reward in our favor. Rule number 2, position sizing. Even with rule number 1 in place, if we do not consider rule number 2, our position size, we're going to use all of our money on one singular trade. And what happens? You're going to lose all of your capital right away. As a beginner trader, you should start with about $1,000 in your trading account. What does that mean? Your position size should be no more than 5% of that initial 1,000. If we have $1,000, 5% of that is going to be $50, meaning we should not be risking more than $50 per trade. Once you start to develop more and more capital, that 5% is going to decrease to about 1 to 2%. And why is that? Well, you don't want to be risking 5% once you have $100,000 in your account. You'd be risking $5,000 per trade, and your account is going to take massive downswings and upswings, and mentally that is going to throw you off. And once you start trading with more money, the more your emotions are going to be involved. And rule number 3 of the game, do not quit your day job. As a beginner, there's a massive learning curve that you're going to have to get over. And if you decide, oh, I'm going all in on this trading thing and I'm quitting my job, you are going to set yourself up for failure. You're not going to have any cash flow coming in. Also, you're going to become a liability to the people around you. If you have bills to pay, all of a sudden you can't pay the bills because I lost it all in one trade, and then your wife's going to want to divorce you. And it just goes down this slippery slope that I don't want to see any of you guys go down. Also, when you have a job, you're going to be able to fund your trading account more and more while you're learning. All in all, what do these 3 rules actually give us in the game of trading? It gives us, as a beginner trader, our only edge. These 3 rules, if you guys were to learn something from this video, these 3 rules are by far, as a beginner trader, the most important thing that you can learn as a beginner. I cannot stress this enough. I've lost thousands of dollars simply because of these 3 rules. It wasn't my setup, it wasn't the profits, it was these 3 rules. Please follow these damn rules, because this is your one and only edge as a beginner. Now that the game is bent in our favor, and now that we actually have a true edge, let's get into the technical analysis side of our edge. Now, in regards to your technical analysis edge, start with one setup that is consistent, that has been consistent on your demo account, and is also within the rules that we have set for ourselves to bend the game in our favor. This means your setup follows your risk to reward. This means your setup also follows your position sizing. Without those, your technical analysis edge will absolutely mean nothing. You also have to determine within that setup, what kind of trade is this? Is it a scalp? Is it a swing trade? Is it a reversal? Is it a continuation? There's multiple factors that you have to consider and define before you can really call it a setup. Knowing what type of trade you're going to take before you take it is within the realm of your technical analysis edge. Now we know what type of trade we're going to take, let's talk about the order types to actually fill the trades. The first order type you guys are probably going to run into is a market order. What is a market order? Let's say we wanted to take the trade if price broke through this resistance level, right? So price coming up, and we want to get filled right away, instantly. We would do a market order right here, so we get filled right away at this price. That would be considered a market order. Typically with a market order, you're going to get filled right away with no problems whatsoever. Depending on the equity you're trading, if you're trading something like SPY or QQQ or futures, you're probably going to get filled right away, no problem. And on the flip side, if you wanted to sell a stock at a given price right away, we would do a market sell order. Let's say we wanted to short the stock right here, we would do a market sell, and bam, we would short it right here. We would get filled right away. That is the concept of a market order. The next order type I want to talk about is a buy limit order. Now, what is this? It's very similar to a market order, but also very different, right? So let's say we had a demand zone like right around here. Price goes up. We say, oh, this is around 120, let's say. Price is 120. We are going to set our limit order for 120 right here. So at 120, we're going to buy the stock. So price comes back down, our limit order is automatically going to activate. And then therefore, we are now in the trade. On the flip side, now we're going to talk about a sell limit order. So let's say we bought the limit order at this 120 price, and then let's say we have our supply zone around here, and that's 130. We're in the trade at 120, and now we're going to set that limit order for 130. And once price reaches it, our trade is going to automatically fill itself. This is how you would use a limit order and a sell limit order. Moving on to the next order, we have buy and sell stop orders. Let's say we entered the market long around here. We're going to want to put our sell stop order somewhere around here. This is going to be our risk management, aka our risk to reward ratio. This is our risk, and let's say our take profit is right around here. And this would be our profit zone, right? So if we scale it out, it's about a 3-to-1 risk to reward ratio. Look, just simply looking at this chart. And let's say price goes down to this level right here, it will automatically market order us out of the trade. And on the flip side, let's say we wanted to short the stock. So we enter the trade around here. We have our buy stop order because it's a short, and then our take profit around here. So this is our profit, and this would be our risk. You can see how buy and sell stop orders is very important in your trading because it's a whole part of your risk management. And very similarly, this is going to be our final order type we're talking about, and it's the buy and sell stop limit order. So same concept, we go long here, we have our take profit here, and then our sell stop limit order. And so instead of it being a market order that goes out of the trade, it will be a specific price, meaning it will be a limit order. So it's the same concept, just more specific with that price. Now, the final main point I want to bring up is we have to treat trading like a business. The ability to scale your trading business is unbelievable. Trading is one of the most scalable professions in the entire world. But trading is one of the hardest professions in the entire world. It takes someone about 3 to 5 businesses before they eventually find that one business success. This can be very similar to trading because you could blow up 3 or 5 accounts before you start becoming profitable. These are just the realities of trading as a whole. It's one of the hardest professions in the world, but once you get over that curve, it will be one of the most rewarding things you have done in your entire life. In this video, we talked about an astronomical amount of things that are going to benefit you on your trading journey. What are we going to do first? We know we can't set our expectations too high because we're a beginner. If we have unrealistic expectations, we're going to get let down way too easy. As a beginner, you're going to be bad at the thing you're doing first. You only get better by you keep doing it over and over and over. We learned about market terminology. We learned about candlesticks, trends, and a whole bunch of indicators. We learned that we need to trade on a demo account first. We need to practice our edge. We need to practice our strategies. We need to see our setups. We need to learn market structure. And most importantly, we learned how to bend the rules in our favor. This is risk management and position size, and keeping your day job. Keeping those 3 things in mind, that is your true edge as a beginner trader. We also learned about the different types of orders we can take in the markets. A market order, limit orders, and stops and stop limits. Now, with all that information, I'm confident that you guys are now ready to tackle the markets as a beginner trader. Remember, we're still beginners. We're still in the beginning step. The moment you give up is the moment you lose. If you guys found value in this video, please drop a sub, drop a like, drop a comment if you have any questions. And I look forward to seeing you guys succeed on your trading journey. Thank you for watching.